What are the different types of investment risks every investor should be aware of? Let's find out. Number 1. Market risk. Equity risk applies to an investment in shares. Equity risk is the risk of loss because of a drop in the market price of shares. Interest rate risk applies to debt investments such as bonds and debentures. It is the risk of losing money because of a change in the interest rate. For example, if the interest rate goes up, the market price of bonds will drop. Currency risk applies when you own foreign investments. It is the risk of losing money because of foreign exchange rate fluctuations. Number 2. Liquidity risk. Liquidity risk is the risk of being unable to sell the securities at a fair price and converting into cash. Due to less liquidity in the market, the investor might have to sell the securities at a much lower price, thus losing the value. Number 3. Concentration risk. Concentration risk is the risk of loss on investment due to excessive exposure to a particular security or an asset class. In concentration risk, the investor has higher chances of losing value as the money is allocated to limited securities and investment types. Concentration risk can be reduced by diversification within and across asset classes, sectors and geographies. Number 4. Credit risk. Credit risk applies to debt instruments such as bonds and debentures issued by companies and government entities. It refers to the risk of default and non-payment of interest and/or principal on a bond or debenture. The issuer may face financial difficulties due to which it may be unable to pay the interest or principal, thus defaulting on its debt obligations. Number 5. Reinvestment risk. Reinvestment risk is the risk of loss from reinvesting principal or income at a lower interest rate. Assume you buy a bond paying 5%. Reinvestment risk will affect you if interest rates fall and you have to reinvest the interest income at 4%. Reinvestment risk will also apply if the bond matures and you have to reinvest the principal at less than 5%. Number 6. Inflation risk. Inflation risk is the risk of loss in purchasing power because the investment value does not keep up with inflation, which implies that the inflation rate is higher than the return on investment, resulting in capital erosion. Inflation risk is particularly relevant if you own cash, fixed deposits or debt or fixed income securities. Asset classes like equities and real estate offer some sort of protection against inflation because these asset prices tend to rise in line with inflation. Number 7. Horizon risk. Horizon risk is the risk of shortening of investment horizon due to unforeseen or personal events such as loss of job, death in family, marriage, buying a house, etc. This may force investor to liquidate the investments that were to be held for the long term. In order to deal with horizon risk, it is advisable to maintain an emergency fund with a corpus of 6 months of your monthly expenditure. Number 8. Longevity risk. Longevity risk is the risk of outliving your savings or investments, which particularly pertains to retired people or those nearing retirement. Number 9. Foreign investment risk. Foreign investment risk is the risk of loss from investing in foreign countries. If the country as a whole is at the risk of falling GDP, high inflation and unemployment, war or civil unrest, the investment could lose money. So, how do you manage your investment risks? Please let us know in the comments section. Follow us on Instagram and Twitter for more such valuable content. Also, subscribe to our YouTube channel, and if you're enjoying the content, be sure to drop some likes and comments, and share it with your connections. Thanks for watching.